Hello and welcome everyone to the Mutual Fund Talk. We have spent an unprecedented 2 months in more than a century or so. That's something also that our elders can vouch for. Being impacted by COVID-19 pandemic has brought the whole world under a lockdown kind of a situation. The lockdown of economic activity has impacted us pretty massively, such that the markets have gone through a tumbling down kind of a phase, and literally so, and so very fast. But now, with most of the lockdown being behind us, this has also led the market into a recoup kind of a phase. So let's talk a little more about it today with our speaker, Mr. Vinod Bhatt. Welcome, Vinod. So Vinod, global equities. Yeah, hi. So global equities have continued the strong positive momentum in May after posting gains in April. So how do you see the markets in the global backdrop?
Sure. So yes, global equity markets have seen a rally in May, mainly fueled by easy liquidity. For example, in the US, the S&P 500 index has risen almost 40% from its low seen in March and is now only 8% below its all-time high. Now, bear in mind that we have seen further downgrades in global GDP growth estimates, escalations in the US-China tensions, and even the corporate earnings in the first quarter of this calendar year have been weak. Yet, global equity markets have continued to move higher as the central banks are expected to further expand their balance sheet to support their economies. The number of new COVID-19 cases is slowing down in most of the developed countries. Progress is being made towards new vaccines and medical solutions. Economies are being reopened and economic activity has also started picking up. So all of these factors are contributing to a positive sentiment in the global markets.
Sure. So Vinod, like I initially started with, India is actually catching up, and especially now that we are having almost a week of the kind of a winning streak where markets have been going up. So what is the kind of thing that you see Indian markets? How do you look at it going forward?
Yeah, so Indian equities have underperformed because the fiscal stimulus package that was announced was a bit underwhelming. Although the finance minister announced a stimulus package of almost 21 lakh crores, which is 10% of GDP, the actual fiscal stimulus was modest, only in the range of 1 to 1.2% of GDP. Now, we have seen a rally in the past week or so, largely driven by FII inflows, and because beaten up sectors like banking and finance rallied, and also some other cyclical sectors like auto and metals have done well. Right. So after seeing a low of about 7,600 in March, the Nifty has bounced back almost 30%. But we need to keep in mind that it is still 20% from its 52-week high of around 12,350.
Vinod, the GDP numbers were released recently. What is your outlook on growth, considering the numbers that are out right now on the expected GDP growth?
Sure. So, Meja, you must have seen that our fourth quarter GDP growth number came in at 3.1% year over year, which was better than expectations. And the full year FY20 GDP growth has come in at 4.2%. However, in the first quarter of FY21, we are expecting a record contraction, which will likely drag down the FY21 GDP growth into negative territory. And this was also mentioned by our RBI governor last week. So we believe that in addition to the economic package that was already announced, we really need some additional measures for reviving growth, mainly in the form of, stimulating demand. And the government has also indicated that it is open to considering them down the line. Now, the positive aspect is that the RBI has been proactive in its policy actions and has cut its policy rate by 40 basis points last week. We believe that going forward also, the RBI will continue to provide policy support and backstop to the economy. Also, another interesting data point is that the liquidity surplus in the banking system, which was very high at about 8.5 trillion rupees, has come down to about 6 trillion. So this indicates that banks have started deploying some of the excess liquidity into the economy, which is good for growth.
Sure. Talking about macros, Vinod, so crude oil has been one of the most talked about topic, considering it made unprecedented kind of lows. and have started rebounding also now. So what is your view on crude oil, currency, such and other critical macro parameters?
Fortunately, in this difficult environment, the key macro factors are actually favoring India. So we had seen in between that Brent crude prices had fallen considerably. They have rebounded now because most of the global economies have started reopening, and we have also seen production cuts by OPEC. But they are still in the range of $35 to $40 a barrel, which is quite comfortable for India to manage our current account deficit. We have also seen that the dollar index is weakening because of the excess liquidity being supplied by the US Fed. But the rupee has been stable at around 75 to 76 for the dollar, so that's also good. And lastly, the IMD has forecasted this year's rainfall to be normal. So this is, very good for the rural recovery.
Sure. Vinod, in the background of this COVID-19 and the new norms that have got set for everybody, how do you see the overall business environment and the effects of the same on the market playing out going forward? So what I mean is, what is going to be the new kind of life for people? What are your views on that post with COVID being with us?
Sure. So we have already seen COVID-19 having an impact for the past 3 months, and it has now become the stage on which everything is being played out, right? So in India, we have seen that to curtail the spread, the government has extended the lockdown to June 30, but mainly in the containment zones. And there is a phased reopening of activities outside the containment zones. So that's already starting to show up in some of the key indicators. So for example, electricity consumption has increased, petrol and diesel consumption is also improving. We have seen that the e-way bill generation is up from the lows, and custom duty collection has also improved. Now, one thing we have done is, we are trying to look at other countries to see how the recovery is going on post their relaxation of the lockdown. So, for example, in the US, most of the states have come out of the lockdown, but we are seeing that demand is recovering only gradually and only in select sectors. So, for example, people are still very apprehensive about going out in crowds, although there are some civil unrest and protests going on, but in general, retail sales have not picked up. Same thing in China, which has been almost a month since the lockdown was relaxed. The industrial activity has picked up. For example, manufacturing has improved, car production, smartphone production has improved, but retail sales is still picking up slowly, and services activity is also a little bit dampened. So, for example, in China, domestic flights are only 55% of the pre-COVID levels, and the restaurant traffic is only 45% of the pre-COVID traffic, and so on. So, learning from US and China, what we can see for India is that, even in India, it will take some time for the sectors to recover. So, for example, in some sectors like consumer staples or telecom or the agri-oriented sectors, agri-chemicals and so on, obviously they will recover faster. In other sectors, for example, two-wheelers, banking and financials, oil and gas utilities, we will see a gradual recovery once we see come out of this lockdown. And for some of the other sectors like construction, real estate, cars and so on, it will take a longer time to come back.
Vinod, with the market starting to recover, there are certain sectors which are more in limelight than the others, like pharma, telecom, utilities, agri. While there were some tremendously beaten down sectors like banking, heavyweight like banking. So what is your overall view on sectors, and which are some of the key sectors that we are looking at from a portfolio standpoint?
Yes, Medha, like you pointed out, the pharma sector has been doing really well over the past few months in this environment of the COVID-19, mainly because the export demand for pharma has also been strong, and even the domestic demand has held up quite well. And as we all know, in such an environment, health is the first point in everybody's mind, and hence the pharma companies have seen robust demand even in this environment. Similarly, telecom, with everybody working from home, communicating more, the demand for data has gone up, and that's why the telecom sector has also been doing well. Like I had mentioned, the monsoon is expected to be good this year. The Rabi harvest has also gone well, and the government has announced a number of schemes for farmers, even in the fiscal stimulus package, and hence the rural economy is expected to do quite well. So that's why we expect the fertilizers and agri-chemical segment also to see robust demand. In addition, I would also like to mention the two-wheeler segment. We believe that coming out of this lockdown, small-ticket consumer discretionary items, including two-wheelers, should do well. The demand should see a ramp up fairly quickly. So we are positive on the small-ticket consumer discretionary and two-wheeler segment. Now, coming to sectors which have been beaten down, one is of course the banking and financial sector. The concern there is that with in this environment, a number of people are expected to see job losses or a cut in their salaries and so on. So the concern is whether they will be able to continue servicing their loans. Now, the RBI has given a moratorium up till the end of August for all loans, but that impacts the banks and the NBFCs. And hence, there was a cloud on some of these names. But in the past week, we have seen a rally because the valuations have become quite attractive. Right. Also, sectors like metals, which is exposed to the global economy, had also seen a downturn. But the global economy is expected to recover faster than India because the fiscal stimulus has been quite extensive across all major global economies. Hence, the metal sector has also done well over the past week or so. The oil and gas and the utility sector should also see demand increasing as we come out of the lockdown. Hence, even these cyclical sectors like banking and financials, metals, and oil and gas and utilities should also recover from the current positions.
So, Vinod, while talking about these industries and how are they been faring, how does it translate into earnings growth? What is your view there? And do you, and in the backdrop of that, do you still think that valuations continue to be attractive for our long-term investors?
Yes, we are tracking the earnings data very carefully. The Q4 FY20 earnings season is still going on. And out of the Nifty 50 companies, 26 have announced their results so far, wherein the revenue has increased by about 2% year over year, but the profits have declined almost 14% year over year. So for FY20, we are projecting the Nifty earnings to decline by about 2% for the full year. And looking forward, the first quarter FY21 earnings growth is expected to be weak, and that will drag down the full year growth. So we're expecting further downgrades, but as of this time, our projection for FY21 earnings growth is a contraction of about 5 to 10%. Now, if you look at valuations, because of the rally in the markets of the past week, the Nifty trailing PE has become, close to the long-term average, and the yield gap ratio is also close to the long-term average. And the trailing price to book is about 15% below its long-term average. If you look at forward multiples, for example, if we take the reduced earnings estimate, then the forward PE is slightly above its long-term average. So overall, we can say that the valuations are reasonable at this point, not very attractive as such. But if you look at the mid caps and small cap, the mid cap index is at a 5-year low, and the small cap index is at a 7-year low. So this indicates that mid and small caps warrant a closer look based on their valuation. So overall, I can say that investors have made reasonable returns from current levels.
Sure. So we've spoken about quite a few aspects now, Vinod. So just to summarize the whole thing, if you were to give me a couple of points on the market outlook, just to summarize our entire discussion together, that our viewers can look forward to, just a couple of points.
Sure. So on the global markets, because of the expectation of a quick recovery post the lockdown and the high liquidity provided by the Fed, we may see the markets, continuing to go up. In India, we have yet to see a peak in the number of new COVID-19 cases. So the market volatility is expected to continue, and we believe that the market will remain range bound. And as a result of this continuing uncertainty because of COVID-19, because of, for example, the escalation in the US-China tensions and so on, the near-term upside is expected to be capped in the Indian markets. On the other side, if we don't see the number of new cases peaking out soon in India, then there could be a possibility of a correction. But we believe that the recent lows that were seen should hold because, one is that abundant liquidity has been provided by the RBI and the interest rates have also reduced. So that's why overall I would say that the markets are expected to be range bound, and investors can continue with their current equity exposure.
Okay. Coming to investments now. So what would be your recommendation to investors from their portfolio standpoint, considering this whole market situation in mind?
Sure. So I would say that any correction, if it happens, would be a good opportunity for investors to increase the equity exposure while maintaining a balanced allocation. So at this time, there can be a tilt to large caps in the portfolio. Although, like I said, the mid and small cap segment is also starting to look attractive. In terms of our funds, on the diversified side, investors can look at the ABSL Focused Equity Fund, Tax Relief 96, and the Equity Advantage Fund. And in terms of thematics, one could look at the ABSL Gen Next, Pharma Fund, and the MNC Fund. And investors who prefer low volatility can look at our Balanced Advantage Fund.
Vinod, you mentioned a couple of Aditya Birla Sun Life's funds in the large cap, multi-cap space. So my question to you would be, from an investor's portfolio standpoint, how should he differentiate between Aditya Birla Sun Life Focused Equity Fund or Aditya Birla Sun Life Equity Fund and an Aditya Birla Sun Life India Gen Next Fund? What should be like his thoughts on allocation in these funds?
Sure. So the Aditya Birla Sun Life Focused Equity Fund is a focused fund, so it only has 30 stocks in the portfolio. The Aditya Birla Sun Life Equity Fund is a multi-cap fund, so it can invest across sectors and themes, right? So it has full flexibility to invest across large caps, mid caps, small caps, and so on, and across sectors. And the Aditya Birla Sun Life Gen Next Fund is a thematic fund, which focuses on segments that will see increased demand from the next generation of the population. So the Focused Equity Fund, you can say, focuses on investing in high quality companies, so companies that have good earnings growth and cash flows, very strong balance sheets, and high ROE. So we will find names like, for example, Hindustan Unilever or Reliance Industries, Bharti Airtel, and so on. And in the past couple of weeks, we've added Eicher Motors, for example. So these are the kinds of names you will see in the Focused Equity Fund. It's a large cap fund, so it's a little bit more stable than, for example, if you look at the multi-cap category, like the Aditya Birla Sun Life Equity Fund. So it has a large cap allocation of about 65 to 70%, and a mid and small cap allocation of about 25 to 30%, right? So in addition to some of the names that I mentioned earlier, like Hindustan Unilever, you will also find names, the mid caps names, like, for example, PVR or Exide or Castrol, which have done well, right? So the Aditya Birla Sun Life Focused Equity Fund, the style of the fund manager is more growth at reasonable prices, and Aditya Birla Sun Life Equity Fund is slightly a little bit more of a value tilt, a little bit more of a mid cap tilt. So it can do well even in market downturns. And the Aditya Birla Gen Next Fund, like I mentioned, you will find names like Asian Paints, Nestle, or Dabur, Hindustan Unilever. You'll also find some of the banking names like HDFC Bank, ICICI Bank, and so on, because these are the segments where the younger population, we think, will be gravitated towards, and that's where the demand will come from. In terms of allocation, like I mentioned, in the current environment, investors can have a little bit of a tilt more towards large caps. So in their overall equity portfolio, for example, about 35% can be to the large caps, about 35 to 40% can be to multi caps, and the remaining can be to thematics and mid and small caps.
Sure. Thank you, Vinod. Your views were very enriching. I'm sure our investors and our viewers have also found it very useful and interesting. Thank you, viewers, for listening to us. Thank you and happy investing.
Thanks, Mila.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.